Hello and welcome to our conversation with Jeff Adler, the Vice President of Yardi Matrix, one of the most comprehensive data tools out there. This talk will feature conversations about the affordable sector, challenges of the multifamily industry, and what is ahead for 2026. Jeff, thank you for joining us.
Sure,
For
pleasure.
our conversation. In your role with Yardi Matrix, you look at a bunch of data every year, and we've just wrapped up Q3. What do you think are some of the main challenges that the industry faced this year?
Well, I actually think the industry, if you look at the U.S. multifamily industry, it's actually held up pretty darn well. Again, all things considered, right? So we have a very high level of supply, 500,000, 550,000 units being delivered, very high level of supply. And that supply has gotten absorbed, which is pretty amazing. That supply is also highly concentrated in Sunbelt cities and in Sunbelt in the Mountain West. High growth cities, but it's gotten absorbed, maybe not prices people would have hoped for, but it has gotten absorbed. And part of that is the fact that there's a huge spread between single family homes, the price of homes, and the cost of rent or an equivalent basis. And we see that exhibited in much lower total turnover. And interestingly, also in a historic spread between the execution of renewal rents, which have been going up 3-4%, even in the face of markets where the new rents, new lease tradeouts, are down like 3% or 4%, or more.
Okay, so there's anxiety from...
Well, I wouldn't say anxiety. It's just, the folks are following the economic incentives, which is, it's the folks who would normally, one could posit, would have moved out to a single family home of some kind. They're not, they're staying. That means that there's fewer units available to lease, which is enabling that to try to flow over to new properties that are being delivered. Yeah. Those folks don't really want to move, so they're accepting modest increases, but still increases. And they're not incented, even though they might be able to save money by picking up all of their stuff and moving around. They're not doing it because we also see, we can infer from the age of first homeownership, which is up to a historic 38 years, that the renter cohort is older than it had been in the past, and so is less inclined
to move. Yeah.
Right. So all of that is cushioning, and I'm focusing for the moment on, let's say, the Sunbelt markets and Mountain West markets.
Where the growth is,
where the supply growth had been most prevalent. Okay, yes. I'm focusing on those parts. So it certainly seems to be the case, right, that the fundamentals have been cushioned because of this effect, and therefore, while nationally, rents are 0.5%, 0.75% year over year on new leases, they're barely positive. But again, we look at renewal tradeouts, they're 4%. That is providing the cushion that is preventing a lot of distress from emerging in the sector. Now, there are other markets, the Northeast, Midwest, where rents, even on new leases, have been growing 3-4%-ish, in addition to renewals going up, in addition to the rents that had grown during COVID. So it's increases on top of the COVID levels. And a relatively new development, recent development, is that San Francisco definitely has turned around. The Bay Area has definitely turned around from its very sort of depressed levels coming out of the pandemic. It's not nearly at the same level of cumulative rent increase as the other markets, but is definitely up off the mat, as it were. And that is something that I had discussed previously, because last November we saw a change in the political administration in San Francisco. We saw a change in the public safety conditions, and in addition to the sort of much ballyhooed AI investment and surge, the combination of those things have resulted in a dramatic increase, in performance in San Francisco, which is on par with what's been going on in the Northeast and Midwest. So when you take a look at all those conditions put together, it's been pretty decent. Now, to be honest, by the time this gets released, September asking rent report, will be out on the street, and it's soft.
Okay.
It's soft. So it does appear, that demand is softening with the sort of like the continued softening in the job market. So, there's always a sort of balance or a sort of equilibrium, between people who were staying, but they had a job, but they were staying, versus people who is there enough job formation to encourage them to form a household and rent an apartment? It does certainly seem as if the balance is a little off and a little weak, a little on the weaker side. And I suspect that will continue for the next probably 6 months. But I do think come next spring, things will sort of begin to strengthen again. But I do think this next 6 months, I think other folks in the industry, other economists have kind of said, yeah, we may not go into a recession, but we're gonna skirt it. And I think that's probably true. You got a lot of macroeconomic forces in play that have created crosswinds. And that's how I kind of think about the administration's fiscal policy, these set of crosswinds that are in play, which I think eventually resolved the benefit of economic growth, but not at least for another 6 months.
Yeah, because essentially the discourse around the economy is that it's complicated and it's up and down, and there are forces that might stifle some of it, but that doesn't necessarily directly translate to the multifamily industry.
The multifamily industry is, in my mind, has always been fascinating because it is both a financial service and a consumer good all at the same time. And it is influenced by short and long run economic forces. And there are some major economic forces like deglobalization, like the aging of the population, also things like immigration policy, which has an influence, we are seeing that, security policy and trade policy, tax policy, energy policy. So it's the way I think about it is there's a set of levers that each administration pulls in different degrees to achieve a policy mix which is consistent with its goals. The Biden administration had a set of policy mixes or a policy mix. The Trump administration has a policy mix. The policy mix is different. They're different. They're pulling
different things.
They're pulling different levers to different degrees. But you have to look at all of the policy levers and not fixate on one particular policy lever because it will often lead you astray.
That makes sense. So, from a data provider's perspective, what are some of the core enhancements to be done by the industry in order to successfully weather these complex sets of economic crosswinds?
I mean, for what we've been kind of focused on, we've always focused on good rental information, good sales information, good supply information. We've also added things like rent-to-income data from our screening division, as well as average household income information from our screening division. We've always, while we've been able to look at like expenses and expense growth and actual lease trade outs, total turnover. So a lot of the things we're talking about are driven by insights from the data itself, like what's happening with turnover, what's happening with renewal trade outs versus new lease trade outs, what's happening with our expectation of supply, what's happening with these other components, and also being a bit of have a broader perspective in that we're also looking at not only market rate housing, but also affordable housing, big A affordable, in terms of that is a segment of the market which needs to be taken into account, the interaction effects between those two subsegments. It used to be the case that they were almost like two different worlds. And what we're finding is in many jurisdictions, they are definitely interacting with each other. So there's some that are still quite separate and distinct, but that's because there's big affordability problems. And that's been kind of an interesting experience that as we've added this additional information to kind of broaden our view. We also cover the SFR BTR segment, which is this, again, if you think about affordability of single family homes being quite high, there is a need for a segment of the population that would like maybe they have decent earnings, they'd like a little more room, but the sort of the ownership cost or the down payment requirements just don't work. So I think the development of an SFR BTR dedicated segment is a welcome addition to the product kind of portfolio, okay, that enables a wider range of choice. And we cover that segment as well. That's been pretty kind of interesting.
Covering or growing SFR BTR would be, I mean, keeping proportions, an affordable option for the people that maybe have most of the income to make a transition into a single family, but don't have the down payment.
Right. That's right. And it's not a huge segment. Most single family rentals are what we call scattered site. They're in distributed neighborhoods. They're in established school districts. They're largely owned by private owners, individuals. There are some single family REITs that are managing scattered site. I think they own maybe 400,000 units in total out of like 17 million. The SFR BTR segment that we track, which is purpose-built communities over 50 units, is about another 300,000-400,000 units. Again, relatively small niches in a very large kind of pool. And just again, for context, the multifamily sector that we cover is something like 24 million units. So again, you're talking about very much of a niche, a valuable niche, but it's still very small compared
underexploited.
And I think there will be continued growth in that segment over time. Right now, a lot of the deals don't pencil for development, and because it's a new product, the inventory is mostly going to be development. But I think that's an interesting segment. I feel it's a consumer need, and I think it'll succeed over time.
So we just mentioned kind of the industry adapting to a bunch of these trends.
Yes.
The real estate sector at large is considered relatively slow to adapt to new technologies. How do you see it incorporating new technologies like AI to handle all of these changes?
Well, I mean, first of all, I think the multifamily, both the single family rental industry and the multifamily industry have been increasingly adopting technology because of the requirement of just efficiencies due to the spike in expenses and the sort of inability at times to be able to translate that into rental increases. There's been an absolute emphasis on cost reductions across utility management, procurement, leasing, the entire sort of activity flow. It definitely has been an increase in adoption. Obviously, we're seeing in our results across the industry. Now, if you're talking about AI, there's a couple of different strategies that the company and we are pursuing. One is to embed AI components inside the existing products, right? Just an example would be maybe a chatbot, or when you're in procurement, right? Proposing a complementary product compared to another product, so there's other sort of AI components that gets built into the product. There's sort of separate AI products that support decision making, and there's some emerging work on how to leverage agentic AI to do complex tasks, which improve overall productivity of team members, either on site or at the headquarters staff for some of their support functions. We're still early stages, and it is true that the real estate industry is more finance driven than it is operational efficiency driven in the main. But I do see that technology adoption is an important complement to the sort of the core operations of real estate companies. Real estate isn't a technology business, but it is becoming a complementary kind of function.
So the pressure of efficiency, of moving a little faster and making it all work out financially.
Making it work out. And if you think just in terms of for on the operations or sort of at the property level, it's finding real efficiencies both in materials and labor. And at the headquarters staff, if you think about the staff tends to be very expensive, highly skilled. So if you're able to make that team more efficient, you're able to either do more business with the same people, or when analysts turn over, you just happen to hire one fewer than you otherwise would have. Those are real meaningful cost reductions.
Yeah.
Yeah.
So we, during one of our previous questions, covered a bit the affordable issue. And Yardi Matrix now has an affordable housing product.
Very much so.
This increasing focus on affordable housing, what have been some of the challenges of entering that space? Because you also mentioned maybe at times a disconnect between parts that make the sector work and an understanding of all of the intricacies of it.
As a sidebar, the Matrix had always had the affordable housing properties in our data set. We knew they existed. Mm-hmm. We knew who owned them. We knew who managed them. We knew something about the debt when we did track the sales. But one thing we hadn't done is to sort of model the revenue stream or to segment those properties in ways for analytical purposes that were meaningful to the people in the industry. And so we went about the process of trying to figure out. So part of it was driven by the idea of, hey, affordability has become a real thing. It's a real problem. And there was emerging, this was 2-3 years ago, you could already tell there was an emerging sort of ask among state and local governments that, hey, we have to do something about increasing the amount of affordable housing out there. So there was emphasis that something needed to be done, something could be done. And then when we began looking at it, we kind of said, gee, there's a lot of data hanging around all over the place, but it's very hard to wrap your head around it and to do the kind of analysis that you would want to do to is this a good purchase? Is this a good development? How would you go about doing that? You actually need to know data about the market as well as data specific to the requirements of affordable housing. And then when we kind of dug into it, we said, hey, one of the core things to do is to pull the LURA, the Land Use Restriction Amendment, and to model the revenue stream, at least from a maximum standpoint. And so we went about doing that. We're like, hey, we're good at extracting information. We're good at pulling documents. Let's go do that. And then just working with some existing clients and other people in the industry, we kind of it began rolling. We did one thing, and then people said, hey, we're not really getting our max net rents. So that calculation of max net rents is helpful, but sometimes it's not. Oh, I hadn't really thought about that. I grew up in New York, where the affordable housing was below market, and you had a wait list. And I was appropriately educated that that's not the case everywhere. So then we were wondering,
it's
why?
Actually a pretty specific.
Yeah, why? Why is that? Why might that be? And where does it occur? So we began collecting the actual offered rents on affordable properties. I didn't think we'd have to do that. And then lo and behold, when we did that, we then figured out, holy patukas, there's a lot of markets where there's competition for customers between affordable and market rate. And market rate tends to win that competition because it's easier to do business with.
Yes.
Then talking to the people in the affordable industry, they said, they needed to adopt technology in order to compete for customers because it was too hard to fill out all the forms. Didn't know about that. And then I've been hearing, from Chris Voss, who runs our affordable housing business, about verification services and all of the streamlining of the leasing flow. And I initially thought, again, I grew up in New York. Why do you have to make things so much easier? Well, when you understand that in probably a good 60-70% of the markets, affordable actually is in a position where they have to compete for customers. You understand the need for that technological streamlining. Anyway, so we began doing that work. Then about a year and a half ago, we launched the service. We've been in touch with organizations that are in the light tech industry, public housing authorities, state housing finance agencies, and all of them have need of understanding the market. Then we said, well, gee, we ought to split out our new supply forecast so we understand the number of units that are fully affordable. Apparently, no one had ever done that before.
Okay.
So I was surprised. Right? So a lot of these things have been one thing after another, kind of following our nose. Another thing that just kind of happened, again, wasn't crazy, is I stupidly thought light tech is affordable housing. Oh no, there's at least on full counting 550 separate, smaller federal, state, and local housing programs that all have different attributes.
Mm-hmm.
And now we're tracking those,
Figuring out
through
what they
those,
are.
and what are the implications of that, and what are the rules associated with that,
Mm-hmm.
and the most recent the properties built recently are incredibly complex in terms of the regulatory requirements, the overlapping programs,
Mm-hmm.
the sort of AMI distribution of the units, and it's quite complex.
Mm-hmm.
So that led us to one thing, and then another thing that just occurred was I was talking to, again, it was about 2 years ago, the GSE green programs had certain AMI and partial affordability requirements.
Mm-hmm.
And this client of ours asked me, well, how could I quickly tell whether a property qualifies for this incentive? I need to know the average AMI level where the rents are affordable to that, so I can see, will it fit potentially into these programs?
Mm-hmm.
And we're like, hey, we could do that because we know the tables, we know the household structures. All we have to do is look at the asking rents and back into the AMI level at which those rents are affordable, which we have now done.
Yeah.
And we've also now done it at the bedroom level, because a lot of our developer clients said, well, when I go to get an approval in a jurisdiction, I need to demonstrate the need for housing, and I need to know at a bedroom level how many units exist at certain AMI breaks. Apparently, nobody had pre-calculated that, so we're doing that too. So it's been a process of kind of following one's nose
and figuring out what the industry actually needs.
Yeah, actually needs, and just doing a lot of listening and following up. And it's been, the reception in the industry has been really great, and we continue to make enhancements and improvements to it. But everyone that I've been talking to has said it is an absolute game changer, not just in modeling the affordable housing components of the revenue stream, but understanding the interaction effects in the entire housing market, or the entire multifamily housing market. It's been a lot of fun, and we've learned a lot.
Okay. I think the latest affordable housing research bulletin
Yes.
put out by Yardi Matrix focused on something you mentioned, that
Yes.
competitiveness between
Yes.
fully affordable and market.
Correct. And we had we put out previous bulletins on expenses and other sort of areas of interest. This particular bulletin was interesting, not only because we could do that analysis at a market level, but we can do it at any level of aggregation. So the other part that we're sort of coming across is, if you do this even at a sub-market level, you definitely see that there are certain pockets within a city where there's a big differential between income levels and average and market rates, and when that spread is quite expensive, then there's definitely a need for affordable housing in that section of town. There's other sections of town where there's abundant supply of housing at the sort of maybe 60% of AMI level. So if you're going to add new light tech deals into that neighborhood, well, you are improving the age of the housing stock,
Mm-hmm.
but it's not as if, unless occupancy in those sub markets like 98%, which most of them are not, you're not really improving affordability. Now, like you're having a sort of local, whereas you could go into a portion of town where things are very expensive, and people in that part of town could truly use them. So we're in conversations with both developers and state housing finance agencies to say, do you actually understand
where you
the
could make an impact?
The structure of the housing market in your area? Because the light tech deals are based upon the state's qualified allocation plan. And the state's qualified allocation plan never took into account local competitive dynamics. Why? Because they didn't have the data.
Mm-hmm.
That's an interesting and intriguing kind of conversation that we're having with state housing agencies.
Mm-hmm.
And we're also talking to a lot of public housing authorities. Now, in the past, the public housing authority's job was largely housing choice voucher administration and taking care of a certain number of public housing units. Well, they've kind of become developers in a meaningful way. And again, where should I develop? Where should I acquire right? Because in many, I've seen a number of situations where public housing authorities have acquired market rate properties and put on maybe either floated bonds to create affordability or obtained 4 or 9% tax credits to put in affordability, right? There's also been some conversion of market rate properties by private sector owners. The question is, well, where? Where should this occur? Where's the benefit associated with it? And all of that requires a level of detailed market knowledge, which we're now able to provide with ease and at scale. So, I mean, I'm quite excited about what we can contribute to the housing industry, both market rate and affordable. And increasingly in 2026, the partially affordable world. There's a lot of discussions going on with the changes in the law in Texas related to the use of that program, or in some cases, they're concerned about abuse.
Okay. So kind of expanding the functionality to match what's needed in the industry.
Exactly.
So since you mentioned 2026, to wrap up, let's look ahead to some of the goals you have set up for next year.
Well, I'd say here's first looking at what do we see the market kind of playing out. The fact of the matter is, I think the first half of the year will be pretty challenging for fundamentals. I think the capital market condition will improve some, but let's focus on fundamentals. If job formation is kind of sluggish, and you continue to have a fairly significant new supply pipeline, which kind of levels out in 2027, I think most Sunbelt markets will be relatively challenged for the first half of the year. Once that supply kind of dissipates, or the supply surge begins to dissipate, then we expect to see kind of a turning in fundamentals, right? Where there's an eventual upturn, gradual, but 27, could see meaningful rent increases. 28 to 30 is a little bit of a wild card at the moment, because we don't really see an upsurge in projects that are work being approved now and being funded now to deliver in 28 through 30. So if we now have some other dynamics about, well, how many households are actually being formed, right? If in fact fewer households are being formed, and part of the surge in households that existed were due to immigrants who are, we believe something like 2 million immigrants may have left, right? That reduces household formation, which then reduces the need for supply, right? Demand and also the need for supply. We may hit, so I'd say 28 to 30, I still don't have a lot of clarity on, but it's very, very clear through 27. We know pretty much exactly what's going to happen there. But as it relates to 26, I think we'll see a turning in fundamentals mid-year, third quarter 2026, where rents stop falling, bottom out, and start moving upward, even in the high supply markets. And in the other markets, good, modest growth, And then transaction markets tend to lead what's going on in the fundamentals. And so we're already seeing a pickup in certain levels of precursor activity that will express themselves in transactions earlier in 2026. Because once investors sort of see what is a bottom, then they'll basically see through that bottom and underwrite it. And short-term interest rates starting to come down, that does allow certain debt instruments to sort of work that weren't working before. So that's kind of how I see sort of next year is, I'll call it a transitional year from extremely challenged fundamentals to turning some kind of a corner in those markets. So that's kind of an optimistic. What we're, as an organization focused on is continuing to kind of add value, updating our forecasting. We're already kind of focused on the needs of the professional research community to obtain data sets that really help them do their job, and as well as the world of a partially affordable, which we think that there is a need for, and we're in a position. Again, it will take a while. This isn't going to happen all of a sudden, but that is a segment that we think we can create value.
Jeff, thank you for a very
Yeah.
insightful and detailed conversation.
You bet. It's a pleasure. Take care now.